It's 10 a.m. right here in Lagos, Nigeria. It's the decision day trade. Right here, we'll be getting the first lending rate decision for 2025. But first, let's get to the top stories that set your investing agenda. I know investors right here waiting patiently. But let's get a check on what's playing out with oil. Oil prices, they edged lower today after an industry report showed a build in U.S. crude stockpiles as tariff concerns. That weighed on sentiment, falling back from gains made in the previous session on worries over supply disruptions in Russia. I know yesterday we had about over 1% jump there in oil prices, but we're seeing a pullback right there to start the trade today. 0.29%, that's the drawback there for Brent. $75.82 a barrel. The U.S. grade WTI, that's $71 there, 95 cents. The March contracts, they expire today, and the more active April contract, that is about 0.26%. Oil prices held near 1 week high just yesterday, but we're seeing all that gains there. Profit taking happening right there. All right, to other stories now. Nigeria's broad money supply, M3, that surged to 110.98 trillion naira in January 2025, reflecting about a 17% year-on-year rise from 94.61 trillion naira in January 2024. According to the data from the Central Bank of Nigeria's Monetary and Credit Statistics, the rise is largely attributed to an increase in both net foreign assets and net domestic assets, signaling a growing liquidity trend in the economy. These new figures come ahead of the Monetary Policy Committee's meeting. We're getting that decision today. The meeting started yesterday, where the country's interest rates will be reviewed, amid concerns over new inflation data at this point. The uptick in money supply is expected to influence discussions on strategies to manage inflation and stabilize the naira. Additionally, Nigeria's net foreign assets that rose to 35.39 trillion in January 2025, marking a 19% increase from 29.7 trillion in January 2024. And the Central Securities Clearance System have unveiled Reg Connect version 2, a significant upgrade aimed at improving operational efficiency and user experience for registrars in Nigeria's capital market. Set to go live, that's for February 28th, 2025. Reg Connect version 2 builds on the success of its predecessor, Reg Connect version 1, which was launched in 2019. While version 1 streamlined data exchanges and simplified the user experience, version 2 introduces enhanced features, including real-time validation of submitted data to ensure accuracy and reduce processing times. The new version also offers seamless API integration for retrieving investor portfolio balances, processing transactions, and generating daily advice files. Additionally, a monitoring dashboard has been added to enable real-time tracking of data exchanges and the processes, further boosting operational efficiency. And global tech giant Microsoft, they've unveiled a $1 million initiative to equip 1 million Nigerians with artificial intelligence skills for the next 2 years. This was announced by Microsoft's managing director and Microsoft Nigeria and Ghana, Olatomiwa Williams, during the Microsoft AI tour in Lagos. The tour was designed to discuss the future potential of AI and its opportunities across various sectors. Take a listen.
I am so delighted to announce that as Microsoft in Nigeria will be investing $1 million in the next 2 years to empower 1 million Nigeria on AI skills. This is a significant investment in our drive to ensure that everyone has access to the right skills that they require to really not just only use AI, but to build solutions on AI, build businesses on AI that will be a sustainable means of livelihood for Nigerians and give Nigerian youth opportunity to compete globally with their counterparts.
Top on the burner now, as the Monetary Policy Committee of the Central Bank, they began the rate-setting meeting. That was yesterday, and today we're expecting the decision at this point. And it's what's before this monetary policy right now, this committee, we've had quite a stable naira, so far, and it's new inflation data with the new methodology for reporting inflation in Nigeria. We did rebase from the last one that we were using before now. So for December, definitely we saw inflation way over 30%, but now we're down at 24.48%. So all of this before this Monetary Policy Committee, what are they going to do next at this meeting? Are they going to raise rates? Are they going to cut rates or maintain status quo? That's the question now. Joining us for this conversation, we have Mr. Tajuddin Ibrahim. He's the Director of Research and Strategy at Chapel Hill Denham. We also have Mr. Kalu Aja. He's a financial expert joining me from Texas. It's good to have you both on the show.
Hey, Ladi.
Thank you very much for having me.
All right, let me start with you, Mr. Kalu Aja. So, looking at what's playing out so far, let's start with the MBS latest inflation data with the rebasement that we had, recently, 24.48%. That's the new data. Does this make the job of the MPC easier, or is it confusing things at this point?
Yeah, thanks for the question. It's a curveball because what they've done is they've changed the methodology. Inflation itself has not gone down. If NBS said in the report that they released that the prices of goods have not come down, what they've done is they've looked at the CPI basket, taking food from 51% to 40%. So in essence, we're counting less food in the basket. And because we're doing that, then of course inflation has come down. But the price of increase in food is still up. It's still up at 24%. So if you're in MPC, are you saying because the methodology has changed, does that actually affect the price of rice in the market? That's your question. And if you say the price of rice has gone down, then of course you want to drop rates. But if the rates are still going up, because we look at the trend line, not just the absolute figure, but the trend line, it hasn't come down. So if it's still going up and up and up every month, then you then have to ask yourself the question, if I reduce rates, what am I really doing? Am I reacting to a change in methodology, or am I reacting to a change in the price level? That's the question I'm going to ask today, and it's been interesting to see the answers.
Right, and definitely that question has to be answered, at this point. But let me come to you, Mr. Tajuddin Ibrahim. So, definitely, I know you guys have been, talking a lot and giving out notes about what's playing out with this new inflation data. Is the first MPC decision meeting in 2025. What are you expecting?
So my expectation is for the Monetary Policy Authority to keep interest rates unchanged. And when I say keep it unchanged, I mean the monetary policy rate being kept at 27.5%. There are some reasons around that. Number one is that we now have an inflation rate that looks smaller than the monetary policy rate. I understand that what has happened is a mere change of methodology, and it does not necessarily, translate into much lower inflation rates. But the reality is that from now on, the old series are gone. It is the new series that, the authorities and even the financial market will be referencing to make economic and investment decisions. So what this implies is that you are going to see everyone taking a look at 24.48% as Nigeria's inflation rate for January. But I think that is not what the Monetary Policy Committee should focus on. I think they should reflect on the development in January. When you take a look at January inflation, which is 10.68% compared to the base in December, when they did the rebasing. So it is important for the Monetary Policy Committee to see a couple of months, like over the next 3 to 4 months, to really understand the trend of the newly rebased CPI before they can make concrete decision around possibly cutting interest rates. But I think a safe decision for them would be to hold the rate constant today.
Right, and looking at this new the inflation data for January, that's 24.48%. We have MPR at 27.5%. I did talk about this yesterday. So we have positive interest rates for the first time in a long time. But how are your investors? How are they reacting to the inflation data? Is it making your job, harder? Advising some of your clients in where to pile cash at this point?
Honestly, it is making my job a lot easier because as at the beginning of the year, we had communicated to investors around the world that Nigeria this year most likely will be witnessing lower inflation rates. Not necessarily because the movement in the increases in the prices of goods and services have slowed down. It is not that those movements have really slowed down. It is just that there is a change of methodology. And when there is a change of methodology, the market reacts very quickly. If we look at the beginning of the year, we already advised investors to expect lower inflation rates and hence lower interest rates and lower yield on investments this year. And the strategy that really will have played out was for investors to front load on fixed income investments and money market investments at the beginning of the year. And it's reflected in the Nigerian Treasury bills results of yesterday, where we had the swap rate come down significantly, particularly the 1 year yield came down to about 22.5% thereabouts. So which is now a situation where we have a much lower yield on 1 year instruments compared to previously 25-26% yield that we were witnessing in the market. So it is reflecting in the market. The market is reacting quickly. Because the case of introducing new methodology to measure the CPI is like a case where the authority of the country introduces a new currency note. When a new currency note is introduced, that is what everybody takes a look at, and the old currency note becomes illegal to be transacted in, and nobody really wants to look at all of those anymore. So that is the reason I reckon that the market and the authority should be looking at the month-on-month change in the newly rebased CPI, how it plays out in the next 3 to 5 months. No doubt the market is reacting to the lower inflation by pricing in lower interest rates on fixed income and money market instruments.
Investors actually beat inflation, with most of the investment. But let me come to Mr. Kalu Aja now. So we have more data out, and this time it's money supply. Broad money supply, that increased in January 2025. We're at 110.98 trillion from January 2024's 94.61 trillion. That's about 17.3% increase in money supply. We've had over about 850 basis points hikes so far from the Monetary Policy Committee, trying to tame inflation and mop up all of that excess liquidity. But we see the money supply, keep going higher. Talk to me about how the MPC would, see this new data. That's for Mr. Kalu Aja.
Yeah, I think the reality is that spending has not reduced in Nigeria. Forget about the prices. Spending has not come down. We spent about $2 billion in December 2024 to finance the 2024 budget. That's still in the market, right? So the petroleum prices are still up. So if you go to the man on the street, he's still spending at the quote-unquote 34% inflation price today. And that's what you see this drive through liquidity in the market. There's too much cash in the economy. There's less productivity in the economy. That's what's going on. And then when you now say you are rebasing the inflation rate, what you've done is that you are talking only about the market itself and not the economy. So the market will react and say, yes, inflation has come down, MPR is still up. there'll be a reaction in the financial market. But the economy is where we're now going to be looking at and say, okay, will this translate to a fall in prices in the Nigerian economy? And that's the question that your guest is saying. We have to then watch what happens next month and what happens the month after. Inflation used to be driven by food. Now it's just 40%. Let's see what the new methodology would bring. If we then see inflation in Nigeria going down officially, but prices of energy, the core, energy and food, keep on going up in Nigeria, there becomes a disconnect, and people might not then trust those numbers that are coming from MBS. So we've got to watch it here. We can rebase the inflation to zero by saying we just want to measure, say, for instance, MTN cards. But the reality is that the economy and the market are two different pathways, and they've got to basically talk and align with each other.
What do you think the CBN can do at this point? Because, we've seen all the mopping up activities, so far, but it seems it still keeps increasing. That's money supply. What do you think should be the strategy, in 2025? So we can see reports of money supply actually going down in the economy.
Well, honestly, I don't think the CBN has a lot of ammunition, or should we say options. It can only raise rates, it can increase monetary policy numbers, CRR. It can do all those, what we say, the fundamentals with the banks. But Nigeria is still largely a cash economy. Remember what happened when we tried to go to a cashless economy and the economy almost ground to a halt. So the CBN really has to ask itself today, we've done inflation targeting, and we have kept growth muted because the SMEs can't borrow at the rate we have today. Is it time for us to sort of pivot and say, let's also look at growth? Let's also look at targeted credit to core sectors that drive job creation in Nigeria. Because all we've done in the last year is to chase inflation. The MPR has not caught up or reduced inflation. The CBN is now behind the ball in that the statistics guys have said we are going to change and bring on inflation. For CBN's numbers, the trend line is still up. So CBN has to ask itself, should we pivot now towards growth because we're not going to catch inflation? They might catch it now because that is 24. But even at 24%, really, which SMEs can borrow at this 27% MPR rate? So that's really the question for me. Do we do growth or do we still do inflation targeting? And if we do that, what happens to the economy? Remember, we're chasing jobs. We're chasing a $1 trillion economy in about 5 years, 2030. And all these things have come to play with lower rates so that SMEs can borrow, create jobs, and grow the economy.
All right, definitely. We're trying to, create jobs at this point, and it's not looking very easy, with the way we're seeing things right now. But let me come to Mr. Tajuddin Ibrahim now. So definitely there are new numbers, and we have a decision coming up today for what lending rate to be. This is the first one for 2025. What do you think will happen to most of the stocks trading today? How do you think investors are going to react? Mostly, we've seen investors mostly shrug off, most of the rate hikes. In other climes, when we see rate hikes, we see stocks get hammered. So, Mr. Tajuddin, are we seeing more positivity for the stock market here?
So I think the way to look at it is to even stand from the standpoint of the connection between the financial market and the economy. So now that we are having the market reacting positively to the lower inflation rate, what it implies is that corporates will be able to borrow money at relatively lower interest rates, because we have some corporates in the pipeline that most likely will be bringing to the market as Chapo Dynam to issue commercial papers to fund their businesses. Those businesses will be funded at much lower interest rates, which implies that CP rates most likely are going to go down. When businesses are able to borrow from the financial market at much lower interest rates, it translates positively to the economy, because it means that from that standpoint, the cost of borrowing is coming down. So we expect that to begin to play out from the month of March onward. In terms of market reaction, I reckon that the market most likely is going to react positively. I'm speaking to the stock market in this case. Reacting positively implies that the market will be viewing it as the cost of borrowing for companies coming down. And most likely the beneficiaries would be non-financial stocks. Non-financial stocks because we know that the banks, generally speaking, like high interest rates because that is when they make huge money on loan disbursements. That is when they make huge money on investments in government securities and other investment, excuse me, assets. So it is not really good for the banks from that standpoint. But it is good for the cement manufacturers, the consumer good companies, the healthcare sector, because they should be able to tap into the financial market to get capital, either short-term or long-term capital at relatively lower interest rates compared to what we had last year. So from that standpoint, it is positive for the stock market.
The fixed income market.
So the fixed income market, it is also positive because what it means is that if you were to mark to market your fixed income instrument, it means you now have much lower yield. And when you mark to market, you have higher prices on the current holding of your investment securities. And then you have more profit in that regard on a mark to market basis. Where the downside risk is for the fixed income instrument is that new investment will be booked at much lower interest rates, and that will imply lower cash generation over the next sort of 6 to 12 months for such investments. But no doubt on a mark-to-market basis, it is a lot of money for fixed income investors because when they sell, they'll be selling at much higher prices because yields are now getting depressed as we speak.
Thank you for that, Mr. Tajuddin. Well, Mr. Kaluaja, so most of the international investors I've spoken to recently, most of them have talked about like this is the best time for Naira assets. And we've seen some of them actually say they're going long, on Naira assets in 2025. Mr. Haja, do you share this sentiment? Do you think, with what we've seen so far with the Naira, do you think it's really time to hold Naira assets in 2025?
Well, if you look at a report came out yesterday, if you look at all the asset classes in the world, i.e. from, say, U.S. stock market, Japanese bonds, everything, the best performing asset class today is emerging markets stock markets, then commodities. So when you are buying Naira, that means you're selling dollar. Essentially, that's what you're doing. So everyone is looking at what's the dollar doing. Rates in the U.S. are coming down. So if you then want to get that yield, you've got to take more risk, which is there. You look at emerging markets. When I mean emerging markets, not Nigeria for now, but the developed markets. But again, it rubs off on Nigeria because if Nigeria is paying you 8% via the dollar and the US is giving you 2-3%, going back to 2-3%, and of course Nigeria becomes very, very attractive, even with that risk that Nigeria has. So if you want to buy at a quote-unquote discount, because the Naira is still trading at, say, 14 or 1500, Nigeria looks like a discount through earnings, through the exchange rate. But then you are buying that systematic risk of Nigeria, i.e. once you get in, then you are in Nigeria, and then you are now exposed to the issues that occur in Nigeria. But in terms of attractiveness, Nigeria looks cheap right now when you compare to what you might get if you go outside the country. So that could answer your question. Globally, assets are moving away from developed markets towards emerging markets, equities, because of course the US, the inflation has come back down in the US, so fixed returns in the US are not offering you that 4, 5, 6% that they were offering, say, a year or two ago. So it's cheap. If you want to take the risk, Nigeria looks like a cheap option for you right now.
What do you think this will do for domestic investors? With what we're seeing with the data change for inflation, with the rebasing. Do you think investors in Nigeria they're going to have it better, in 2025 than previous years?
It really depends on what. See, the good thing with Nigeria right now is that the budget looks, because of Dangote, If we're able to cut that spending that we're using to import PMS, that frees up the government to say reduce its deficit. If they reduce their deficit and they do not borrow, then interest rates in Nigeria start to come down a bit. If there's more fiscal discipline on the government side, it allows the private sector to really roam and the animal spirits to just take control in Nigeria and then create these jobs. We need to get foreign direct investments into the country. We need to get the infrastructure working. So we need positive news. We don't have to build the railways yet, but we need that positive news that folks are coming to invest in the country, remittances are going up, Naira is becoming stronger. That's what's going to ginger the enthusiasm for folks to bring out cash from the fixed income, from the dorm accounts, and invest in the real sector in Nigeria. There's tons of cash just lying in banks, lying in CPs, lying in bonds. It needs to come out of those instruments and go into the real productive economy to invest in infrastructure, to invest in trade, to create jobs, and then to boost consumption at the local level. If we don't do that, then we might not have missed that train on really growing the economic base of Nigeria.
All right, thank you so much for that, Mr. Aja. But let me come to Mr. Tajuddin now. Are you seeing good news coming? Good news that could, catalyze the markets more for Nigeria in 2025?
Well, I think some of the good news that can catalyze the market is that we see sustained stability of the FX rates. Once we have stability, we are positive that foreign investors will be interested in this market. And if you also consider the fact that with stable exchange rate as we speak, and also elevated yield on investment, the carry trade for foreign investors is still robust. I mean, we have a case where our 1-year treasury bill is about 22.5%, 5% yield. And in the US, you get not more than 4% or thereabouts. So the carry trade is still robust at around 18% or thereabouts. So my sense is that even if there is a cut in interest rate in the coming months, most likely we will see the foreign investors liking Nigeria in terms of the carry trade, because the carry trade coming down from 18% to 10% is still decent in my view. So we expect that to continue to underpin the way foreign investors play this market. Corporate results most likely will be announced, from next month to April. We expect those numbers to be robust for the banking sector. We expect those numbers to be convincing for the consumer sector from a recovery standpoint. Now that we have, stable FX rates, most likely the final quarter of last year for them was a strong one. The cement manufacturers most likely will also be reporting interesting numbers. But let me come back very quickly to the Monetary Policy Authority. I think there most likely will be a need for them to adjust the asymmetric corridor, because we now have a situation where the lending facility rate is now lower, is now around 26.5%. And instead of banks to now go to the T-bills market, where we now have yield being lower, I think that rather would be going to the CBN's window to deposit. So the CBN is paying more than what the market is willing to pay. There may be a need for the Monetary Authority to take a look at that corridor in that regard, in my view.
All right, thank you so much. Well, about 2 p.m. today, we should be able to get that decision. That's the first one for 2025. What's the lending rate going to be? Will it be a hold? Will it be a hike? We'll definitely find out. But thank you so much, Mr. Tajuddin Ibrahim, Director of Research and Strategy at Chapel Hill, Denham, and Mr. Kalu Aja, a renowned financial expert. Thank you both for coming on today.
Thank you, Ladi.
All right, let's head straight to the commodities market. Now, and I have with me right here Dr. Ifeoma Nwokolos, the Research Manager, Financial Derivatives Company. It's great to have you. First decision for 2025. We're having that today. But first off, I'm hearing some good news in the FX market, especially the market we don't talk much about, as the parallel market. We're seeing appreciation there. What's driving sentiment?
Yeah, I must tell you, I was astonished when I saw the appreciation last night. So this is, one could begin to ask, is this sustainable? It was so sharp that the last time I came, it was 1545.
And now we're seeing
and it's 1514 now.
Wow.
So this is speculation-driven appreciation, which may not last, it's temporal. Then this is because people that are in their holding position are beginning to release the dollar they have in the market. Ordinarily, Nigerians, the dollar is supposed to be a derived demand. You must have a need for it before you purchase it. But for Nigerians, we just purchase it for purchasing sake, just for a store of value. So a lot of people that kept it for a store of value are waiting for Naira to appreciate. And if you look at the trend since December up until now, Naira has continued to appreciate. Another great uncertainty is the decision of the MPC. They don't know what it's going to be. So everybody was like, please, let me let out this dollar before it crashes more than this. Coupled with the fact that Naira, we have Naira scarcity. Yes, there's Naira scarcity. So you want to buy dollar, there's no Naira to buy dollar. There's scarcity, and we have seen that.
Are we talking about cash?
Yes, there's scarcity of Naira.
Right.
Yes. So right now you see that even money supply growth declined sharply from 51% in November to 38.3% in December, and now 17.3% in January. There's a massive decline. So all of this put together plus CBN intervention is making Naira to appreciate, but this may not be sustainable. So before the end of February, we may see Naira trading between, let's say, 1545 and 1550. So it's not sustainable. It's just based because of speculations. That's why we saw this sharp.
And it's quite interesting because we did get data showing broad money supply that increased in January 2025 to about 110 trillion. That's up 17.3%. So I guess there's still a lot of...
Money supply is different from money supply growth. So the figure I gave you is the money supply growth. Right.
So that one is, calming down.
Yeah.
That's the rate of growth there. But we're still seeing a lot of money, in the economy so far. So you're saying that's not sustainable. And now we're getting decision from the MPC today, the first one. Yeah. Do you think there could be more bullish news, when it comes to forward guidance, from the MPC that can make the Naira even get more stronger?
Okay, now everybody is agitated and want to hear what the outcome is going to be. So the best they will do today is to hold the rate. And the worst they will do is to cut by maybe 25 basis points.
So we're not seeing a hike?
No. You can't see a hike. Following the new methodology, inflation has declined by 10%.
So is there pressure on the MPC now to cut rates to maybe below this recent inflation number?
We are not. It's just, I don't know. I say that's the worst they could do. That's the worst they could do. Inflation is not the only variable considered. Inflation is not the only variable. Even though we have just one data point, which is not enough. If they had done like a recalibration backward to say, okay, let's use the new methodology to see what inflation was in December and what it is now. So we'll be able to say, okay, there was a decline or there was an increase. But this is just one data point. It's not enough. Other factors that the MPC is going to be considering is the exchange rate. And we are seeing that exchange rate has been appreciating from December up until now. And the sharp decline we just had yesterday of more than 30 Naira. So another thing they'll be looking at is the money supply growth is another factor they'll be looking at. And MPC or the CBN focus is stability, price stability.
Right. And you just reminded me of a funny post I saw on social media when the Naira was quite volatile. You know, the lady was complaining that, oh, she bought dollars, and now we're seeing Naira strengthening. That when will Naira go down again? So it seems at this stage, but you're saying this is not sustainable.
It's not sustainable.
But the Naira will still be bullish with the way it's looking.
Exactly.
All right. So I guess we'll be waiting out to see what plays out today.
Exactly.
And I'm sure, are we seeing reactions in the domestic commodities market and all of that?
We are seeing reactions in the markets. Let's take Treasury bill of yesterday. There was reaction, it declined. Rates are declining. In fact, the market is expecting a cut. That's why we are seeing the decline. Decline, all the Treasury bill auction yesterday declined by almost up to 100 basis points. So we look at the domestic commodities. Domestic commodities are also declining. Funny enough, yesterday when we did our survey called the market, you see that the price of rice is flat, 100,000. You know, it has been on 120 for a long time. Now it's 100,000. Beans that have been on 140 for a long time declined to 100,000 as well. Tomatoes on the decline, onions on the declines. Where we have slight increases pepper, the price of pepper. So I could say that there are flickers of hope.
Right.
Yeah, in the commodity market.
Right. That's quite interesting. But we'll keep tracking to see what plays out. But right about now, we're going to take it to the global stage. Okay. And we're going to have Inijom Mekwa to come and give us what's playing out. And he did say the price of pepper is going up. And I know he likes pepper a lot. And yeah. It's true. You really like pepper. And the price of pepper is still up.
Well, I don't understand why. I mean, she said the price of rice is declining, and I think Will Ibong also did a survey in the market yesterday, noticed that some commodity prices are either stable or declining. So I don't know what you guys are doing to pepper. It's very important.
Maybe it's in his demand.
It is very, very important that the price of pepper has to reduce.
This is the planting season for pepper.
What about tomatoes?
Tomato is down.
So they should be on the same pattern?
No, they are not.
I thought they worked together most of the time.
That's what I thought too. Who eats pepper with the... It's not fair. It's really not. Good morning, everyone. Welcome to the Global News segment of Business Morning. We'll take you through what's happening in the global space. We'll start from China now. The People's Bank of China, they've maintained interest rates for the fourth straight week. On Thursday, the bank left its one-year loan prime rate unchanged at 3.10%. Likewise, the five-year LPR, the benchmark for mortgage rates, was retained at 3.60%. The decision matched expectations. The bank had reduced its LPRs by 25 basis points each in October 2024, and it fixes the LPR monthly based on submission of 18 designated banks. However, Beijing has influence over the fixing. The LPR replaced the traditional benchmark lending rate in August 2019, and data release shows that the bank lending surged to a record CNY 5.1 trillion in January, but largely due to the season factor. Lending usually remains the strongest at the start of the year. Earlier, Capital Economics had said that given the pressures on the bank profitability, the PBOC is likely to prioritize lowering reserve requirements before proceeding with more rate cuts. The firm said that the central bank will avoid a rate cut that could trigger additional depreciation of the currency amid trade tariff threats. So I wonder if this is, can this suggest that perhaps our MPC decision today will be a hold? We'll just have to wait and see in a couple of hours. And now the European Union's biggest economies are split over whether the bloc should weaken its sustainability reporting rules for companies, with Spain and Italy defending some rules that Germany and France want to be delayed. The European Commission plans to publish an omnibus proposal next week to simplify green rules for businesses, aiming to make local industries more competitive and respond to U.S. President Donald Trump's promise to scrap regulations. The proposal will address the EU's corporate sustainability reporting rules, known as CSRD, its due diligence law, and its taxonomy system for for labeling climate-friendly investment. In a letter to the Commission, Spain's government has asked Brussels not to weaken the due diligence law, which from 2027 will require companies to check human rights and environmental issues in their supply chains. Separately, Italy is asking EU not to delay the rules for the tens of thousands of companies which will report under the rules this year. A letter by Italy's finance minister to the European Commission had this information. Now we move to Australia, where that country has allocated $1 billion to a fund that will support the manufacture of green iron and its supply chains, including an initial $500 million to bail out the Whyalla Steel Works in South Australia. On Wednesday, South Australia Prime Minister put Whyalla, one of the country's 2 steel plants, into administration for unpaid bills and said he wants to help develop lower carbon steel production in the state. Australia is the world's largest producer of iron ore, which earned more than $100 billion in export income in 2023-2024. The wider iron and steel sector supports over 100,000 direct and indirect jobs. And the country will hold elections by May. A key policy for the Labour government under the Future Made in Australia banner is to harness the clean energy transition to drive manufacturing growth and add value to critical minerals. And then in Canada, the federal government has confirmed that small businesses will have to pay tax on their carbon rebates, and despite government's promises otherwise, because Parliament can't currently pass legislation to make the payment exempt from income taxes. But if legislation passes to do the government the government says that businesses can apply for a rebate for the taxes paid on their rebate. And the president and CEO of Canadian Federation of Independent Business says that the situation is a mess. Smaller and medium-sized businesses without a large carbon footprint pay the carbon price on fuel input the same way an individual consumer does, including buying cars for fleet vehicles or heating and powering their offices. Initially, the government was going to set aside 7% of revenues collected from the consumer carbon levy to provide funding to smaller businesses to reduce their energy use. But those programs never worked, and by 2024, more than $2.5 billion in carbon price revenue was owed to those businesses from 5 years of paying levies. In the 2024 budget, then Finance Minister Chrystia Freeland said that the money would be paid to 600,000 small and medium businesses, and those payments were finally paid in December. Now, India and France have unveiled a collaborative roadmap to develop safe, secure, and reliable artificial intelligence as Indian Prime Minister Narendra Modi and French President Emmanuel Macron discussed strengthening cooperation in science and innovation within their bilateral strategic partnership. The 2 leaders expressed their support for including Indian startups at the French Startup Incubator Station. They also welcome the expanded opportunities to utilize India's real-time payment system, unified payment interface, and in France, as well as in France. On February 10 to 11, France and India co-chaired the Artificial Intelligence Action Summit, which gathered heads of states and government leaders of international organizations, small and large enterprises, representatives of academia, non-governmental organizations, artists, and members of the civil society. Now let's go to the UK and see what's happening there. We saw inflation numbers from that country higher than expected. We have Juliana, our correspondent, joining us to tell us perhaps reactions and drivers on that. Hi, Juliana, good morning. So what do we know about those numbers that came out hotter than expected?
Hotter than expected is a good description, Annie. Yesterday, the Office for National Statistics released data showing that inflation, consumer price inflation, leapt from 2.5% to 3% at the beginning of the year. And I think the number that was priced in was probably about 2.8%. And I think this comes at a real surprise in January, because typically at this time of the year, you'd expect retailers to be cutting costs, but that wasn't the case, because one of the highest drivers did come from food. So meat and bread, lots of fruit were also a lot higher at the checkout. And something that's much more controversial in the airways in the UK at the moment is the hike on private school VAT. That increased by about 20% in Rachel Reeves's budget. And because it was implemented quite swiftly, we're seeing that private schools in the UK have charged exorbitant amounts to parents. And this has leapt up the CPI. So yes, really concerning, particularly because today, just earlier this morning, the British Retail Consortium released results of its monthly measure of household sentiment. And economists do look at that survey quite carefully. And it's showing that for a fifth consecutive month, there has been a decline to minus 37. So I think there are concerns now about how the Bank of England are going to weigh this data with cutting interest rates, which are still quite high at 4.5%, especially as we have more price rises coming by the way of higher energy bills, and also the employment tax, which is going to be £7 billion of additional costs to businesses in the UK. So there doesn't appear to be hope on the horizon.
Yeah, well, not so good there. But as you've mentioned, of course, the Bank of England will be the next stop now. But I hear that even the currency is reacting to these inflation numbers.
Yeah, well, I just had a look at the British pound, which does appear to be doing a little bit well compared to the euro. I think it's up 0.16% against the euro at the moment. And that's because I think markets now are weighing the geopolitical risk of what's happening in terms of the rhetoric that we're getting out of the White House, Trump doubling down on those Zelensky dictator rumors. There are concerns about European security. So the pound is doing quite well against the euro, but also as well, the FTSE still lower this morning. It's lower, it's down about 30 points. There have been a slew of results, including from Lloyd's. Lloyd's shares are down this morning, and that's dragged down the market.
And then it seems the conversation around the refugees and British citizenship is back in the news. Refugees who arrive on small boats, lorry, and those irregular means.
Yeah, this is a pretty serious topic, something that's difficult to try to condense. But the Labour government are really cracking down on immigration, which, as you know, is always a hot topic here in the United Kingdom, Innie. And there's been quite an alarming change in the rules about good character. Now, if you do come to the UK and you are successful in obtaining a visa, it does take you multiple years to be able to finally become naturalized and then apply for citizenship. Now, to successfully become naturalized, you have to make sure you adhere to certain rules of good character. And now the law has changed, deeming that if you entered the UK illegally before the 10th of February 2025, no matter how you got here, you can no longer be seen as being of good character. Therefore, you will not be able to apply for naturalization, which is, of course, very frightening, alarming for hundreds of thousands of people, not just those who have arrived on small lorries. Lots of people have come here before biometric with a plane. So yes, this is a concern. There has been the first lawsuit trying to overrule this by a young Afghan, a 21-year-old gentleman who arrived here 7 years ago. But we are living in frightening times, and the UK legal system does change every 6 months or so when it comes to immigration. So please just make sure that you are checked and not fear, but get the help you need if you are falling under this category.
Yeah, it does seem like migrants are not having it easy this time. President Trump is on it, and now we have the UK. I wonder what's going to happen in the future, Juliana, but thank you so much for giving us updates on that.
Thank you, Annie.
All right, Ladia, I hope you're not planning to be a migrant anytime soon because President Trump is on you.
Right.
And now the UK legal system is changing, as Juliana
Even
said.
if I migrate, it will be legal.
Oh, okay.
Yes.
Oh, you're a big boy.
I'll be legal, you know. Hopefully. But you know, it's interesting what's playing out so far. 2023, 2024, the UK, US, we saw the inflation numbers were going down, and
then
they were cutting rates. And you know, fast forward to now, we're seeing Nigeria.
Yeah, because we saw US last week, and it's also ticked up, and now we have UK also up. And
after holding rates
and
in the
it's
US.
food, Laddie. I don't know if you listened to Juliana real well. She talked about the drivers mostly being food. If you remember the US too, it also has to do with food. Because egg was specifically mentioned.
Right.
So I wonder why back here in Nigeria, we are cutting the weight of food when it comes to measuring our inflation, seeing that food is a major contributor. Exactly. You know, I know we now have other factors, you know, contributing to our inflation and our spending.
Are they telling us Nigerians are spending more on maybe data and other stuff?
And
maybe
bank, you know, I think there was the bank charges too. That was also, are we spending more there?
Maybe we're not spending that much on food anymore.
Really?
Maybe.
That is news to me.
We need data for that.
But anyways, I mean, at 1 p.m., we're going to see what's going to happen.
Right.
We saw Japan there holding rates for the 4th time, but I don't think we can say that we are at par with them. So we shouldn't compare the situation because we do have our own specifics. But we see, I heard you talking to Dr. Okolo there about the Naira TikTok, but she emphasized that it's temporal. So let's not get our hopes high.
Even though we've seen stability
Domestic price is going down. Inflation has gone down more than 10%. So, Laddie, we're going to cut
Good days.
We will cut rates.
Good days ahead in Nigeria. Thank you so much, Edie, for the details that was playing out with the global markets. But thank you so much for watching. We're back again at 1 p.m. for the live coverage of the first MPC, that's the rate-setting meeting of 2025 right here in Nigeria. Thank you for watching Business Morning. I'm Ladi Williams from me and the team right here at Channels HQ. It's bye for now.